Hello, this is Charles Conrick. Welcome to session 5, part 5, trading spreadsheet. And in this section, part 5, we're going to be discussing a quick review of everywhere we have been. And in addition, we're going to finally take a look at what in many ways is the essence of the book, which is probability theory trading using spreads. Now, I'm not going to go into great detail on the actual definition of bull put, bear put spreads, bull call, bear call spreads. I leave that again to you're picking up a book by Anthony Saliba or Russell Rhodes. I can't do any better than that. Although later on, I'm considering offering some more courses, but in basics, which may not appeal to this audience, but the actual introduction to options is possible. But you can get a lot of this great information on even the CBOE, Chicago Board of Options Exchange website. So I'm going to sit here and tell you that you might remember from our option position spreadsheet of a couple of sessions ago, we were looking at bull put spreads. And I had told you then, this is a credit spread. A bull put spread is a credit spread, meaning you get money put into your account. And you're probably hoping or thinking the asset will stay up higher because it's a credit spread. What you're trying to do is outlast what's called time or the theta on a option position such that you get to keep the credit that you sold it for. On a bear put spread, which is right above, that's a debit spread. You pay for that, and what you're hoping is that the asset will go down and you make some money on the bear put spread. The payoff diagrams look just like what you see here. If you can kind of remember that, and by what I mean by remember is, if for an example, this idea of the hockey stick up to the, bent up to the right on the bull put and then bent over, and then on the bear put, it's exactly the opposite. The hockey stick is bent up to the left and then like cracked up at the top and bent over. It'll give you some handles on where you should be or would want to be with these kind of spreads. But you're best served to actually look through some of the examples, which we'll be doing as we go along. The call spreads, by the way, look the same thing. Bull call spread, which is a debit spread, the top one here. Bull call is a debit spread, and you're hoping the asset will go up. And the bear call spread is a credit spread, in that you will get a credit into your account. So again, you're hoping for the time to expire, so you get to keep the credit. All right, now we can use either of these spreads or both of them in combination. When we put them in combination, we're going to get what's called a condor. Let me explain that to you by taking a look at the payoff diagram on a condor. Let me get it centered up here where we can all see it, and certainly you can see it. But if an asset was priced at, say, $43, which is right smack in the center, here's what the condor, it consists of a long either put or call. In this case it'll be a put. I'm going to give you an example of an iron condor. If I bought a put at 37, which is right here, and then sold a put at 38, this would be my approximate payoff diagram. Then if I went over the top of the asset, say up at 48, sold a call, and then bought a call at 49, my payoff diagram would look just like that blue colored top hat that you're seeing on the screen. The opposite position, in other words, whoever is trading against us, would have the pink colored payoff diagram. So where we bought a put, this person sold. Then this person, where we sold a put, the high 38 put, this person bought it. And where we sold a call up at the top, which would be, say, about a 48 call, he bought it. And then where we bought a 49 call, this person bought it. So you have the two sides of the trade. Where the credit side is in blue, the debit side is in pink. So what is the pink person hoping for? Well, this person is thinking that the asset's going to go wild one way or the other. In other words, he or she thinks it's going to either go all the way down to 19 or 25 or something, or up as high as 55 to 61, and they're going to get to keep your money. You, on the other hand, in blue, are hoping to buy the put, sell a slightly higher price put, sell a higher than yet priced call, and then buy a yet higher priced call to cover your positions. You're hoping the asset stays in between about 39 to 47 over a given period of time, whatever the expiry of the time is. Now you can do this all with puts, you can do it all with calls, or you can mix the two together. When you mix the two together with puts and calls, it's called an iron condor. If you put together a condor with, say, all puts, you would buy, in this case, you'd buy a 37 put, sell a 38 put, sell a 39, or excuse me, a 48 put and buy a 49 put. You could do it all with puts and or calls. That's certainly a way of looking at it. You can combine all these spreads. So what I'd like to do is, rather than spend I keep these videos to about 30 minutes. Let's take a look at it on one of the better trading websites, which is Options Express. And I've set it up using the SPY. And what I've done is I've gone into Options Express's trade calculator, and all of your online websites will have. So I went up to the toolbox, went to trade calculator right here, clicked on that, and then that gives you the option of putting in, no pun intended, all the options you want. So I typed in SPY, Standard & Poor's. It's date sensitive. Today is Sunday, December the 1st, 2013. The Standard & Poor's SPY ETF closed at 181 on Friday, November the 30th or 29th. And I've set up a trade. Let's take a look at it. The expiration I've set up is the first week in December, which will be December 6th. And I've said, geez, I want to use a 177 strike put, and I want to buy one. Okay. Then I went and set up a SPY week, same expiration, week 1, 178 put, and told it I want to sell one. Now I went over the top, and I went to a SPY, again, expires week 1, nope, it's not week 2, week 1, 183 call, and I want to sell one. And finally, to cover the position, I went in and bought a same expiry 184 call. So you can see the outer leg is a buy 177 put. The inner leg is to sell a 178 call. Then, since the asset's trading at 181, what I did was to go $2 away and sell one of those. And then I covered both of these sides by being, now in this case I'm high, or bought a 184 call. Most trading platforms, including Options Express or eOption or TradeStation, are not going to just sell naked short options unless you have covered positions. In fact, I doubt if they'll ever let you sell a naked call. But nonetheless, I don't even trade them, so I'm not going to talk about selling, shorting positions where I'm not covered. It's simply too risky for me. So we can all, virtually all of us, with if we're approved for option trading, can trade these credit spreads and or debit spreads and attempt to make profit on them. The reason being is, if you stop and think, the 177 put is covering me from too much loss on being short the 178 call. And the long 184 call is covering my short position in the 183 call. So I can never lose that much. However, I can gain a little bit. Now in this trade, Options Express gives you a nice little payoff pattern. So in 6 days or 5 days, right now the asset is priced at 181. And you can see that the maximum profit we can make on this trade is $20 with just one option. Multiplied times 10, that would be 200. Multiplied by 100, and it would be 2,000. Nevertheless, we're dealing with one option. But the most that I can lose is $80. So in effect, what I'm doing is putting $100, I'm putting $80 at risk out of 100, because I'm going to need, and it'll tell you down here, you're going to need $100 in margin to make this trade. But you stand to gain $20, and you will gain that $20. It's a credit spread only if the asset stays between, shows your break-even point, so 177.80 and 183.20. So if by Friday the SPY closes at, say, 183 or at 178, you'll get to keep this $20. That is a iron condor in this case, or a condor. If you were using all puts and all calls, it would be the same type of payoff. But this is called an iron condor. The reason for the condor, for what it's worth to you, I don't think there's anything other than the fact that it looks like a giant bird, as you can see. And going back, doesn't this look the same, except obviously somewhat more elongated than the diagram I just showed you? So you can see your payoff area is right in here. So you've spread the payoff area around. Now the question gets to be is, all right, I'm putting a lot at risk here. I stand to lose $80 against only a $20 gain. And this is where probability theory comes in. I'm much more interested myself, and that is the function of what I'm trying to do here with the theory and with Oracle's crystal ball, is to train you and develop you into a new style of trading, which is not based so much on direction prediction as it is on what is the probability of such a thing happening or not such a thing. Whatever your method, be it fundamental or technical, of predicting an asset's move, up, down, sideways, whatever it might be, you still have to deal with stochastic or unknown events. So the more that we can bring probability into the picture, we will. And that's what the whole focus of the book and my trading style is, and hopefully some of you will become convinced and begin to use it yourself. I've found it very useful, to say the least. So here's the prices on these. If we buy as of close, I'm not saying these prices will be effective tomorrow, but gives us a good approximation of market prices as they stood on Friday. So if you'd have closed out the day on Friday afternoon and bought this trade with 5 days to expiry, this is what you've gotten. So what I've done is taken the trade and put it onto our options trading sheet, which is what we've been reviewing over the last few sessions. By now, I am confident, or at least hope, that you're used to the fact that, don't forget, we have the long put on tab sheet option 1. We've got the short put on tab sheet option 2. We've got the short call, make this a little bit larger so that you can see it, on tab option 3. And we've got the long call, and we'll make this a little bigger so you can see it. Just bear with me a moment while I get it back up and centered. We've got the long call on tab sheet option 4. Now I've taken the liberty of going to tab sheet option 1 and setting the price of SPY 181, which you can see right where I'm playing with the cursor. The historical volatility, which is undoubtedly the trickiest thing outside of an actual asset price move, but guessing or estimating the historic annual volatility. And when I say historic, we're predicting the future historic volatility 5 days out under this trading system. What we're trying to do is say this is what the volatility will be. Right now I'm going to put in an estimate of 8.5%. The VIX closed on Friday at about 13. The VIX generally has a premium to the actual volatility, which I'll be getting into in future lessons. In fact, a very detailed study of using the VIX, the Fear Index, the Chicago Board of Options Exchange Volatility Index, as a method of estimating volatility over the next few days or the next month. And then we'll take a look, we'll be looking at historical volatilities, but that'll be in more advanced sessions coming up later on. So I've set it in right now at 8.5%. And the volatility, I'm just going to put in at 1/2 of that, or 50% of, so it's about 4.25, 4.2. Now, the strike price, interest I've left, you'll notice, at 1/2 of 1%. The strike price I put in is equivalent to what we looked at on the options express sheet, which is the 177 put. And you'll notice it's priced at 27 cents. So what I've done is put in the, and I think I have to beg my pardon, it looks like I put in a 178, bear with me. So I want to put in a 177. So good, that'll give us some experience in changing this. So we'll go in with a 177, and the long put was priced at 27. So we'll use implied volatility to change where the yellow cell, it says put long, up until that says 27 cents. All right, so this is now tied into this. So we've basically backed into what the market, well, we haven't backed, the market told us the price of 27. Therefore, the implied volatility with that time to expiry and all the other assumptions we've put in is right around 17.7%. Now, we'll go to our tab option 2, our short put, and put in a 178 strike. And the price we were given on that was 34.7. So 178 we need at 34 cents, so we'll raise the implied volatility until it reads 34 cents. And there it is at about 15.9. Now you might be wondering why the difference. Well, this is a function of what's called a volatility smile, which is covered in some detail in my book, The Vertical Option Spread 1.8 Standard Deviation Inflection Point, and perhaps in greater detail in, well, it depends on how much detail you want to understand about the volatility smile. I observe it very easily using the option chains. You can look at the implied volatilities, but mainly you're going to be interested in the price. But the further you get away from the strike, the more the implied volatility is going to go up, especially on the put side, simply because people are effectively pricing the options the way they think things are going to happen, which is what affects the implied volatility. But continuing for our lesson here, tab option 3 is our short call. All right, we'll go in at 183. That's fine. And the price on that was given at 26 cents. And I've got that set already. I knew I set one or two of them. So you see the implied volatility on the short call at 183 is only 11%. And that ties into the 26 cents that's in this cell here. And then finally, we'll go long the 184 call, and that's priced at 13 cents. Checking that, 13 cents, and we're covered. So at this point, for this trade, we have a iron condor set up. We have tab option 1, the long put. We've got tab option 2, our short put. We have tab option 3, our short call, and tab option 4, our long call, set up to run a Monte Carlo simulation. So let me continue. Excuse me 1 minute. I wanted to take a look at something on the Options Express site, but all right, I'm back now. Sorry for the delay. So we know from the Options Express site that we have a maximum gain of $20, maximum loss. Let's go back now to our net sheet right here. And don't worry too much, please, about the rounding error. You can try to get it, but there's a slight bit of rounding error. We'll activate our long put. Notice that I've turned off the long stock. I'm not interested in that. So I've turned that switch off, but all other 4 switches are activated to 1. So running this one at a time, what you're going to notice is that your maximum gain, there's your maximum gain, about $20. In this case, it shows 21, but again, that's just a little bit of rounding error. And your maximum loss is at $80. So one at a time, you can see, well, this seems to be, normally a pretty good trade. You can also see sometimes where you're losing the whole amount. But we're more interested in using Oracle's crystal ball to see, well, what is the probability of us winning on this trade over a reasonably long, or a large sample size. So I've set this up here to 3,000. And let's run this trade 3,000 times with the assumptions that we have and set ourselves up a probability distribution using Oracle's crystal ball. So I click the start key there. And now that the trade is all set up, what's going to happen is that you're going to notice Crystal Ball is going to run this 3,000 times in a very rapid period of time and give us an estimate of what our distribution is going to look like. And here it is. Let me close that out. And according to this, after 3,000 simulations, we should hit zero or get our maximum payoff 81% of the time. You'll notice that approximately, it looks like about 8% of the time, we're going to lose the full $80. And most of the time, it shows a slight loss, but less than the full maximum. The key thing that I like to look at would be the mean, which is, all right, was there a mean positive payoff? And in this case, yes, there is. And over 3,000 trials, if you ran this same trade 3,000 times, it's showing you'd make a profit of $6. So that's pretty interesting to me. That's a trade that's showing out of a $20 maximum, 1/3 of the time you're going to make, or excuse me, I should say, over a large sample size. Just imagine 3,000 weeks. That's a long time. You're making a positive gain on this, which makes the trade worthy of looking at. In other words, it's priced such that the odds are in your favor. Crystal Ball is really neat in that you can even look at the statistics, the cumulative frequency of the trade, what it would look like. There's any number of different ways you could look at this, and I'll be getting into it in greater detail with Crystal Ball. I'm going to be introducing you to more details of Crystal Ball. Let me shut down a couple of these windows. One of the things I really like is that you can also extract the data, and I like to look at this, and that's all the trial values. So in other words, here's week 1, week 2, week 3, and so forth, and you can see where your losses, your gains would have come from, and then using the geometric Brownian motion, you can see where the stock ended up on each particular trial. Now, I'm going to be covering this in more detail. This is more usage of Crystal Ball than it is anything else, but you can see the pattern of what your gains and losses would have looked like over a period of time, and then begin to make estimates of and assumptions based upon, all right, what would happen over a long period of time to your profit loss curve, which is extremely interesting. So going back to our spreadsheet, again, going one at a time, you can see this one at a time, what it would look like. And then if we reset the simulator, which we have to do after every run, we can go ahead and run it again. And let's say you said, well, God, can we see 5,000 trials? And the answer is sure. How about 5,000 trials? So set that box at 5,000, click start, and away we go again. It's going to take obviously a little bit longer, but running at extreme speed, which is most of the time where I recommend you run Crystal Ball. It only takes a matter of, when I'm talking here, maybe 30, 40 seconds, something like that. Just to see if the sample size gives us any real major difference. The answer is no. So on 2,000 additional trials, almost double what we used, we're still showing the same statistics. So based upon the assumptions that we built into the trade, what I'm telling you and what I'm suggesting to you is that the probabilities, again, based upon all these assumptions, all of them, on all of them, based upon those assumptions, the probability of winning this trade is 81%, approximately 81%. And the $5,000 stop, by the way, I should have pointed out to you, I've got it set for a $5,000 stop loss. That would never enter into this trade. Would you make this trade? With an 81% probability, I would suggest that that's certainly worth a shot. Now you might be asking, well, what's the probability of me losing? And again, well, you can run the simulation. We'll do it one more time. And what if you wanted to know more of an evenness? And let me explain myself. What the max you can win is 20, and let's say you only want to risk 20. All right, how often is that going to happen? By the way, this curve, let me expand this a little bit so I can show it to you. I've got this set up so that's the distribution of the stock's ending price on Friday afternoon, given the assumptions you put in over the next week. So if you look at the 3 standard deviation points, you can see that Crystal Ball is suggesting to you that 99.5% of the time, this stock is going to trade between 174 and 80 and 187.20, starting from 181. Most of the time, it's going to be within those two. 95% of the time, it's going to be between 176.77 and 185.18. Now, your trade at 180, and we were at 183. Yeah, we were at 183. So here's about 183, and we were at 178 on the short side here. That's going to be approximately equal to the chances of your trade breaking even. So that's where you're at, and gives you a good indication of other areas you might want to trade. For example, SPY options trade in 50-cent strike intervals when they get close to the at the money. You might want to go to 183.50, take less risk, which is a function of what the book is all about. This is probability. This is the basic of probability theory trading. I'm not predicting any asset moves. I'm predicting probability theory. So that's the, I would say, unique and function of the theory behind what you're looking at. If you had a good indication or good thought that, geez, with all of the economic conditions, closing of the year, I actually think that, and you have strong belief the asset's going to increase, in this case the S&P 500, at a 10% annual rate, over the next 5 days. 10% annual. Keep in mind, it doesn't predict 10% in the next 5 days. This means that you're predicting the S&P is increasing at a 10% annual rate over, what would that look like over the next 5 days, and you rerun the model. That assumption will change your probability more than likely to the high side. So let's take a look at the net with stop sheet, which will come up here in just a moment. You're looking at the big picture is the stock price. We're interested with net with stop. And interestingly, it didn't do much at all, as you can see on the trade. It was 81%. It's still 81%. And our mean before was $5, or $6. Now it's $5. So it didn't do anything to the trade in such a short time interval. I thought maybe it might give us another dollar or two. Well, it didn't. So scratch that one as over that short of a time interval. That's probably true, which is one of the reasons I usually leave this at 0, because I don't know what's going to do anyway. Too many random variables. All right, I'm coming up onto my 30-minute interval for length, rather, for these sessions. Let's review where we've been today. We went and looked at the basics of a condor: buy the low price put, sell a higher price put, and in this case I used 1 strikes. Go over the top of the asset, in other words, spread out over the top of the asset, sell a higher priced call, and then buy 1 strike higher call. And it sets up this pattern that looks like the blue colored line. The pink colored line is the opposite side of the trade. Then we went to Options Express's website, and we picked up we set up the strike prices for 1 week from today, or December, 5 days from now, and put in the strikes that we wanted, and we set up the buy, sell, buy. That's an iron condor. It's a 177, 178, 183, 184 iron condor, because we mixed up the puts and the calls. Options Express showed us that, all right, our maximum gain is $20, which is the difference between the buys and the sells. You could compute that by saying I bought at 27, I bought at 13, I sold at 34, I sold at 26, and that would net out to be the $20 profit. the cost or proceeds, that $20 negative, that means a credit to your account. So it's a credit spread. The maximum loss would be that you have to buy this thing back and it'll cost you $80 max. So your risk is capped. They even put up a probability chart, which is of some interest to you. Uh, it's not precise to me, and I much prefer Oracle's crystal ball from doing my own estimates than I do this. But it's a lot of trading sites give you these, but I don't believe personally that they're as good as, not that they're, I believe, I know they're not as accurate or as good as what I've set up in telling you that they're basing things on much less assumptions than I am. I'm going to leave it at that. So then went to our option sheet, and if I can ever get it to show up, there it is. We set up the position with our estimates of all of the assumptions, including the price. Well, that was a known. We set up the long put. We set up the short put by matching implied volatility to the actual price. We set up the short call by strike price and using implied volatility to set up the price. And then we set up the long covering side of the strike, 184 strike, with the implied volatility. We went to our net sheet, activated the toggles that we wanted to use, and then finally ran a number of analysis to show us that the trading spreadsheet was showing that under our assumptions we had an 81% probability, and more important than that, we have a mean expected profit on this trade, making it a worthwhile trade to look into. So in other words, over 5,000 samples, we're telling you, or I'm telling you, that this trade will win 81% of the time, and the mean expected payoff is at least $6. Now, we've only just begun, ladies and gentlemen, and it's time for me to exit already. But this trading sheet part 5 is actually showing you how to set up the iron condor. So in future sessions, we're going to be going, trust me, far more detail and getting more and more complex as we go along. And we'll also be learning how to use Crystal Ball to set up a number of different patterns. But this was your first time, so congratulations and welcome in setting up a full trade, a full trade with real-time data, if you will, and actually running the assessment and seeing the analysis. So congratulations, and play with this. Watch this a couple of times. I know I'm going fast, but I'm trying to get as much as I can through to you so that you can enjoy and use the book in Crystal Ball. It's just a fantastic program, and I think my trading spreadsheet makes it very usable for option traders. So I'll wish you a good day, and thanks for watching, and see you next session.